Welcome to Fidelity Connect's webcast series focused on making you a better investor. Now, I'm not a professional investor by any means. I'm just like you, an interested observer looking to learn more about investing and how I can stay ahead. That's why we're bringing you this weekly series. We'll provide you with insights and information that goes beyond the headlines, bringing in experts from all over the financial world, from portfolio managers and investment professionals to retirement and tax experts and everything in between. We want to help you stay on track to becoming a better investor. Welcome to the show. I'm your host, Emily Adenuevo. Today we're focusing on dividend investing, what it is exactly, and how it can be used as an investment strategy. Joining us on the show to share her insights and expertise is Fidelity Portfolio Manager Ramona Persaud. Ramona has been with Fidelity for over 17 years. Along with managing billions of dollars for our largest dividend funds, Ramona also manages portions of the Global Monthly Income Fund and Global Dividend Fund for Canadian investors. She's headquartered in our Boston offices, but joins us live in our Toronto studios. Welcome to the show, Ramona.
Thank you.
So happy to have you here and talk about this very important topic. And for our first-time investors or mature investors watching the show, if you could just break it down for us to the basics, what is dividend investing?
Dividend investing is just investing. It's actually not much different from investing. There's just a little bit more of a focus on getting an income stream into your total return. So total return has two components. One is price, so that's your price return, and the second component is your dividend yield. So both of those in total make up your return. Dividend investing just tends to have a larger component of the total return be from the income stream, but really it's investing like any other investing.
So would you say it's a stable investment strategy for, let's say, first-time investors looking into it?
Yes, so what is nice about having more income in that total return is that you get a bit more stability, and that is because the variability around price return tends to be higher than the variability around the dividend stream. So dividends are predictable, they're often something that you know ahead of time. Companies tell you what they're going to be, so you just don't get that much volatility around the dividend part. So if you've got enough dividends in your total return, typically the variability around your entire total return is lower. And so for people looking for a more consistent total return stream with less volatility in it, the more dividends you have in that return stream, typically the lower the variability of that total return.
So for people who are looking to invest in dividends, what are some common mistakes when looking specifically at dividend yields?
One of the ways that people think about dividend investing is that you should try to get the highest possible yield in any given stock that you buy. And this is actually proven to not be very sound because when the yield is very high, typically the risk of the stock is also very high. What it typically means is that the price has been quite depressed in order to get that very high yield. So we did a study where we broke up the dividend yield of the market into 10 buckets, 10 equal buckets, if the sort of the first 10% of yield, the second 10% of yield, all the way to the last 90 to 100% of yield. And what you find is if you look at those last buckets, so buckets like say 9 and 10, 8, 9, 10, the return is not that amazing. And certainly the return relative to the amount of risk or the amount of volatility that comes with those stocks is quite subpar. So you're getting quite a lot of volatility. So that tends to be the biggest mistake that people make. They will try to just buy the highest yielding stocks without realizing how much risk is embedded in them and therefore how much volatility you have to incur to get that return. What makes a lot more sense is to concentrate in, say, buckets 6 to 8 of that percentile distribution. So buckets 6, 7, and 8 tends to get you pretty good return with really good risk, and so your return for the amount of volatility that you get is maximized in those buckets. So that's kind of the trick to dividend investing.
And you've talked in the past about taking an active approach to dividend investing. Why is that important to this type of strategy?
Sure. So one, I'm a big believer in active period, but two, certainly for dividend investing, It's really easy in a passive strategy to just go for the highest yields. So I'll give you a great example to try to make the point in the question. Back in 2007 to 2008, the passive dividend strategies, so the passive dividend funds, were loaded up with financials. Because certainly in the US marketplace and even across the world, financial stocks, bank stocks for instance, were offering the highest yields in the marketplace. So in any given passive fund, financials were about 40% of the fund, whereas in the benchmark or in any standard index, financials were 20% of the index. So they were double weighted financials, and we all know what happened in '08, right? Financials all slashed or eliminated their dividends, and that strategy was extremely painful for those passive products. So in terms of taking an active approach to dividend investing, it's really important to do the work, meet with the companies, model out the stocks, model out the cash flows to figure out if they can actually support the dividend, what the fundamentals are that will drive the cash flow, that will drive the dividend, and to be ahead of the curve, especially in terms of dividend cuts. Active is especially important in dividend investing.
And just to branch off on that, what are some key factors you look for in a dividend-paying stock? I know there are sort of three main categories you look at.
So, I actually don't over-focus on the dividend element of a stock. What I'm looking for in my investment strategies is really three things. One, I want investment return. So I want the stock to be able to give me the really nice total return profile. One part of which is that price return, right? And the next part is dividend return. Two is I want a level of downside protection, which means that when the market goes down, these stocks need to be able to perform really well relative to a market that is sort of shrinking. And then three, I want income. So income is only one of three components that I'm looking for. So when I'm looking for aspects of a dividend-paying stock, it's really no different from aspects of any given stock. One is a really good valuation. So I want a valuation that will give me good odds or good probability of getting an investment return, because I'm a believer that valuation is very much tied to investment return. Two is quality. I want the company to have fairly stable and high levels of cash flow generation, which is a function of the company's business model, the competitive landscape, the moats around the business, how much return they can generate, profitability, growth. And if they generate a good and stable return, then they can generate a lot of free cash flow. Then they can really be defensive in a market drawdown. And then three, out of that cash flow, I can get some dividends. So I do that across stocks, irrespective of if they pay dividends. And if I happen to get a good dividend, great.
And if we could just switch gears a bit and talk about your sort of international journey. I know you're of South Asian, cultural background, but you've lived all over the world, South America, US, Europe. Just interested to know how this, international background of yours, it affects or influences your investment philosophy and outlook.
Sure. I think having lived in so many different places and seen so many different things, I think the constant element of change introduced a level of adventure, certainly. So I love adventure. I love seeing new things and experiencing new things, which is why I think I really love global investing. But also introduced an early familiarity with uncertainty. And with that familiarity came comfort. So uncertainty is very uncomfortable, but I think the idea of having a lot of it led to a certain comfort with it. And that comfort with uncertainty, comfort with discomfort, I think has been really helpful as an investor, because investing is all about not having complete information, having a lot of uncertainty, and having to make a decision on it, especially if you have a value lens. If you really like stocks that get cheaper than usual, then you have to be willing to have the sort of stomach for all of the uncertainty that comes with that cheapness, and be able to do the work to really get comfort with the uncertainty, to then make a decision to invest in that company even though the market sort of hates it. Yeah. So that's how I tie my background into my professional sort of craft.
And I love that saying, being comfortable with the discomfort. And what I love about this show is that, for the first time investors watching, it might be a little bit uncomfortable getting into the investing world, right? And, hearing from you and sort of your background, maybe offer some advice to those watching about, taking risks maybe and sort of jumping into the unknown, if you will?
Sure. In investing, my belief is that you have to really be able to separate signal from noise. You have to be able to just see noise for what it is, and most of it is noise, especially in this sort of environment where there's a lot of news flow. So the idea is to be able to develop a skill through practice in being able to understand what is really meaningful and then pursuing that, one. Two is developing a stomach, if you will, for uncertainty. So this is my advice, if you will, with a value lens. A growth investor would probably say something different, but me with a value lens says that if you can sort of practice delving into uncertainty, practice this idea of going into storms when everyone else is running away from the storm, but not randomly, with a lot of work behind it and a lot of thought behind it. If you can, so to make that tangible, if you see a really great company, a company that through time has very stable, predictable cash flows, and one easy way to practice this is if they have a bad quarter, and the quarter to you, seems to have a lot of noise in it, and it doesn't really seem to impact what will happen to the cash flows 5 years out, 10 years out, certainly 20 years out, and the stock goes down a lot. That is an opportunity to do a lot of work to potentially go and buy a company like that. So that's what I do all day long, is look for companies where the 3-year, the 5-year, the 10-year doesn't seem to be that affected, but the market is really focused on the 1 and 2 quarters, the 3 to 6 month view. And if I can take advantage of that disconnect between the market getting overly focused on 3 to 6 months out and there being no change in sort of the 3 to 10 year view, then you can make a lot of investment return. And if it's a quality business, you can make a lot of investment return with very little volatility. So in a smooth kind of way. So that's my tangible way to express going into storms.
And personally, you've been with R for over 17 years. What keeps you motivated in terms of your day in and day out, and just like you said, sitting down and looking at these companies and finding the ins and outs and the opportunities there?
I really like puzzles, if you will. I studied engineering in university, and I think what drew me to that is the idea of being able to take things apart and figure out how they should work together, problem solving. And so coming into investing is really no different. It's taking companies apart, figuring out how they work, figuring out why they don't work as optimally as they should, and then figuring out how should they be put back together in a way that makes them work better. And by work better, I mean, what would make this company more profitable? What would make them grow faster? What would make them generate more cash flow? What would make them give back more of that cash flow to me as a dividend investor? And so what motivates me is just this idea of problem solving and taking things apart, putting them back together in a way that's better, and then dreaming or imagining if the company can actually do that. So that's one piece. And the second piece is what's really motivating and exciting is when I can see it one way and the market doesn't see it the same way. And that creates a disconnect between how the company is priced and what the value might actually be. And when that disconnect feels really wide, that's really exciting. So the thought of being able to see stuff very differently from the crowd, which again is this idea of embracing discomfort. If you're over here and the whole world is over there, that's really uncomfortable. But that's where all the value in life is to be here when everybody else is here. So it's not just investing in my mind, it's literally life.
It's a great mindset, Ramona. And if you can just sort of wrap it up and, like I said, to the investors watching, what sort of key advice would you give in terms of the first step into dividend investing?
If you can find companies that have really stable profitability metrics over time, so whether that's margins over time, so reasonable level of growth, so companies that can grow, but it doesn't have to be hyper growth. Like even if you get 3% growth, but that is a consistent 3 that turns into a reasonably high level of profitability that then turns into pretty good free cash flow generation. So in my mind, this is all about numbers. And you can see that that is pretty stable over a long period of time. Then you can sort of exercise a certain degree of patience to buy a profile like that when it gets derated by the market for something that doesn't seem to affect those characteristics. So you read transcripts, listen to what the companies say. Just in my mind, find your basket of companies that should continue to do the same thing over long periods of time, and just wait really patiently for when the market forgets that it's a really good company, and so it gets really cheap. If you buy a great company at a great price or something like that, then you do really well over time.
Perfect. Ramona, I want to thank you so much for joining us here in our studios. Like I said, you're usually in Boston, so treat to have you here on our show. Thank you all for watching, and don't forget to tune in weekly to our investor show where we delve into more investor topics. And don't forget that we always welcome your comments and feedback, so feel free to connect with us at fidelity.connects@fidelity.ca. Thank you so much for tuning in, and we'll see you next time.